The era of a strong dollar has lasted far longer than most people ever expected. High interest rates, global uncertainty, and an overwhelming demand for safe assets have kept the dollar dominant for years. But financial markets always follow a pattern. The longer a trend persists, the more pressure builds beneath the surface. In the first half of 2026, the foreign exchange market may reach a critical turning point. The Korean won, the Japanese yen, and the Chinese yuan, major Asian currencies, are all reassessing their direction at the same time. Let's start with the Korean won. The won has long been one of the most interest rate-sensitive currencies globally. As U.S. rate cuts move closer to reality, the won is likely to respond earlier and more decisively than most. South Korea is fundamentally an export-driven economy, with steady inflows of U.S. dollars. Historically, periods of won weakness have been driven more by timing than by structural weakness. As the interest rate gap begins to narrow, the case for prolonged won depreciation starts to weaken as well. Next, the Japanese yen. For years, the yen remained exceptionally weak, suppressed by negative interest rates, ultra-loose monetary policy, and its role as a funding currency for global carry trades. Now, Japan is considering a historic shift in monetary policy for the first time in decades. The potential end of negative interest rates and meaningful changes to yield curve control. If Japan returns to being a conventional interest rate economy, the yen may be revalued not as a speculative instrument, but as a stable, trusted currency once again. Finally, the Chinese yuan. The yuan is not a market-driven currency. For China, exchange rates have always functioned as a policy instrument. While authorities tolerated a weaker yuan in the past, they are increasingly aware of the limits of that strategy. Excessive currency depreciation raises the risk of capital outflows and financial instability simultaneously. Looking ahead, China's currency strategy is shifting away from weakness and toward managed stability. In summary, the Korean won responds to interest rates. The Japanese yen responds to policy normalization. The Chinese yuan reflects control and stability. They all face the same dollar, but for very different reasons. This is why the first half of 2026 is often viewed as a potential inflection point in global exchange rates. The objective is not to predict exact currency levels. The real objective is to recognize when the direction itself may change. In 2026, will you continue to watch only the dollar? Or will you prepare for what comes after it? That decision starts now.